Hi, I'm Ross from Crimsmith Property Accountants in Hamilton. We're just going to look today at a structure that's reasonably common in the past, but with ring fencing coming in from the 1st of April 2019, it becomes not so tax effective and it's worth having a look at. So if you have this kind of structure, it's worth re-looking at with ring fencing. So I'll share my screen with you. So basically this structure in the past, we would quite often have rental losses in an LTC. Those losses would flow down to the higher income earner, someone paying 33% tax, and they would get a tax refund from those losses based on the past rules or the old rules before the 1st of April 2019, before ring fencing. So that would give us a tax loss of 33%. On the other side, we might have profitable rentals in a trust. The profit from the trust flowing through to the lower income earner. That person might not be earning at all, so they might pay 10% tax, or we might both allocate $1,000 to each child tax-free when they're under 16. So basically on this side, we're paying 10% tax. On this side, we're getting a refund of 33%. So in the past, the structure was quite tax effective and it worked reasonably well. The problem with it is ring fencing. So ring fencing basically means that we can't offset the property loss against your personal income anymore. So from the 1st of April 19 or for the 2020 tax year, most likely you'll no longer get a big tax refund. So yeah, that old structure becomes redundant. And then what we need to do is relook at, do we need to change it around? Is there a better way that we can do it? And this is a possible structure that you might look at changing to. So the best thing is to come in and see me, come and get some advice around this, but we might look at changing the ownership of your LTC. So rather than being owned by the higher income earner, it might be owned by the trust instead. And just be very careful. There's catches with changing shareholding. So you need to get some expert advice around it. Otherwise you can be caught by the bright line test, or you can be caught by other taxing provisions as well. So get some expert advice, but if possible, we could change the shareholding from the LTC to a trust. The loss then flows through to the profit in the trust, and the two would offset, so you would have a lower profit in paying less tax. Any profit that you do have left then could flow down to the lower income earner. So that's one opportunity, that's one possibility that we might do. Another possibility is you might actually just decide to stay exactly how you are. You might decide that it's okay to build up some property losses building up in the higher income earner, and you might know that those properties are going to make a big profit in the future, or the cost to change might just be too much. But overall, if you have the structure, it's really worth thinking about it, having a look. Is it the best thing? Is it the most tax effective structure, or should you change it around? So hopefully you've enjoyed my little chat. Make sure you keep an eye out for other videos coming up, and also recent newsletters and blogs. We've just had one coming out at the moment about the new built borders rules, which is really useful for a lot of people. And hopefully you found that really useful. And if you're just not sure what to do, you want to change accountant but not sure, you need some advice but not sure, go onto our website. You can organise a free chat for 5 or 10 minutes, which is a great starting point. We can have a basic chat, see can we help, and quite often I can point you in the right direction as well. Thanks a lot.